It's Monday. Let's talk money. It's never too early or too late to start saving for retirement. But where do you start? Let's break down some of the most common retirement savings tools. Up first, Roth IRA. A Roth IRA is an individual retirement account. That's where the IRA comes from. Here's how it works. You put money in that's already been taxed, aka after-tax dollars. An example of this is the money you get from your employer because taxes are already taken out of your paycheck by the time you receive it. The money you put into a Roth IRA has the potential to grow tax-free as long as it stays in the account. You can withdraw money from that account tax-free and penalty-free after you are 59.5 years old, and if the account has been open for 5 years. How much can you contribute to a Roth IRA? In 2025, you can contribute up to $7,000 annually. The amount you can contribute each year may vary, so it's always best to check in with a financial advisor or your financial institution to see if a change has been made. Can you use the money you've put into your Roth IRA to invest? The short answer is yes. Once you've contributed money to a Roth IRA, you can invest in a variety of securities. Some of these include mutual funds, stocks, bonds, certificates of deposits, or CDs, and exchange-traded funds, to name a few. If you're interested in understanding more about using your Roth IRA to invest, it's best to talk to your financial institution about your options. What are the benefits of a Roth IRA? First is that your contributions and any investment gains made in your Roth IRA can grow tax-free. Second is that you can contribute to a Roth IRA at any age as long as you have a qualifying earned income. Third is that your withdrawals can be taken out tax and penalty-free once you turn 59.5 years old and when your account has been open for 5 years. How do you know if a Roth IRA is right for you? One way to determine this is if you expect to be in a higher tax bracket when you reach your 60s, the age you can start withdrawing from the account tax and penalty-free. It's always best to talk to your financial institution to see if a Roth IRA is right for you. How does a Roth IRA compare to a traditional IRA? Let's get into it. A traditional IRA is another type of individual retirement account. The difference with this one is that you can contribute money that hasn't been taxed yet, aka pre-tax, or money that has already been taxed, aka after tax. The money you put into a traditional IRA can grow tax-deferred, which means you won't pay taxes on it until you withdraw your funds. You can withdraw money from your traditional IRA account penalty-free after you turn 59.5 years old. However, the money withdrawal will be taxed as current income. This is a key difference between a traditional IRA and a Roth IRA. If you withdraw money before the age of 59.5, that money will be subject to an early withdrawal penalty fee unless you qualify for an exemption. Traditional IRAs also have required minimum distributions, or RMDs. This means that once you reach a certain age, you are required to withdraw a minimum amount from your account each year. In most cases, the IRS requires that RMDs must begin annually when you reach the age of 73. What are the benefits of a traditional IRA? In most cases, the money you put into your account can be tax deductible. For example, if you put in $7,000, you can claim that amount as a deduction on your income tax return. However, when you withdraw that money once you've reached 59.5, that money will be taxed at the income tax rate for that year. Another benefit is that there are no income limitations to open an account. However, there are limitations as to how much you can put into your traditional IRA each year. So how much can you contribute to a traditional IRA? The annual contribution limit for 2025 is $7,000 for people under the age of 50. If you are 50 or above, you are allowed to contribute a maximum of $8,000 in 1 year. Just like with Roth IRAs, the IRS can change the contribution limit for traditional IRAs each year. So it's important to check in with a financial advisor or your financial institution to see if any changes have been made. How do you know if a traditional IRA is right for you? Because the money you take out of a traditional IRA will be subject to an income tax at the time of withdrawal, these are typically recommended if you expect to be in a lower tax bracket at retirement age than when you first earned that money. Talk to your financial institution to learn more about traditional IRAs and see if they're a good fit for what you want to achieve. Lastly, let's talk about 401ks. A 401k is a retirement plan sponsored by your employer. Not every employer will offer one, but if yours does, here's what you need to know. If you enroll into a 401k, you can designate a percentage of your paycheck to be put into that account. This means that in each paycheck you receive, your employer will put whatever amount you've chosen automatically into your 401k account. There are two types of 401k accounts, a traditional 401k and a Roth 401k. With the traditional 401k, the money is taken out of your paycheck before federal income taxes are applied. You must be older than 59 and a half to avoid penalties when making a withdrawal from this account. When you do make a withdrawal, you will pay ordinary income taxes on that money. With the Roth 401k, the money that's taken out of your paycheck and put into your account has already been taxed, so it can grow tax-free. The same rules about withdrawals apply. You must have held the account for at least 5 years and be older than 59 and a half to withdraw your money tax and penalty-free. Most employers offer a Roth 401k, but it's important to confirm with your employer about which plan they offer. If your employer offers a match, they will put in a designated amount of money into your account based on the amount that you put in. Exactly how your employer's match policy works will vary depending on where you work. What is 401k vesting? Vesting refers to the amount of money in your 401k account that you would walk away with if you were to leave your workplace or take a distribution. Employee contributions, the money that you put in from your paycheck, are immediately vested and considered yours. The employer's contributions to your account, or what they've matched, aren't considered vested until you've remained with the company for a set amount of time. If your employer offers a 401k plan, talk to them about whether they offer a matching option and what their vesting policy is. Is there a contribution limit for a 401k? Yes. Maximum contribution limits are set annually by the IRS. Talk to your financial advisor or financial institution to learn what the limit is for you. There you have it, a high-level breakdown of some of the most common savings tools for retirement. It's always best to talk to a tax professional or a financial advisor to learn more and determine which tool is right for you. Like these tips, follow us at Valley Bank for more money tips.